Hello class, this is a video lecture of chapter 16 from the personal finance text, and this is a chapter on owning bonds. Chapter 15 we talked about stock ownership. Here we're going to talk about bonds. Investors buy bonds to participate in economic growth as lenders rather than as shareholders with less risk and a firmer claim on assets. Bonds are issued by governments and government agencies as well as by corporations, which give investors different kinds of partners in growth. Learning objectives: identify bond features that can determine risk and return, differentiate the roles of various U.S. government bonds, list the types and features of state and municipal bonds. And whenever you see municipal are city bonds. Sometimes they call them munis, M-U-N-I-S, or muni bond. Compare and compare and contrast features of the corporate bond markets, the markets for corporate stock, and the markets for government bonds, and explain the role of rating agencies and the process of bond rating. So here are some key terms. You have the bond issuer, which means the borrower. So if, for example, we're looking at Pembroke Pines, the city of Pembroke Pines, if they are issuing bond, they're the issuer and they're the borrower. And then when you purchase the bond, they're borrowing from you. Bond term investor is actually the lender or the creditor. So if the city of Pembroke Pines, for example, sells you bonds, you are their lender. So normally you go to your bank to borrow money, so they are your lender. But it's the other way around when it comes to municipal bonds or state bonds or whatever. In bonds, you are the lender. Principal face value or par value is the amount that's borrowed. The coupon rate is essentially known as the interest rate. Now, when we're dealing about bonds, specifically about bonds, whenever you see the word coupon, it's not the coupon that you clip out to save 99 cents at Publix. A coupon rate is an interest rate, and a coupon is an interest payment. So when you have stocks, you typically would get a dividend, and that's like a little commission or a little something that the company passes on to you. But when we're talking about bonds, you get a coupon payment or a coupon, and that's the interest payment. Maturity, it means the due date. And that's important to know because in stocks you don't really you don't really have that term. So maturity isn't when you take responsibility and have a deeper voice. And with bonds, it means that that's the due date of the bond. The term is the time until maturity. The yield to maturity is the annualized return on the bond investment per year. And the market value is the current price of the bond. There are a couple different types of bonds. You have convertible bonds, callable bonds, mortgage bonds, debentures, senior bonds, and subordinated bonds. And there's also different types of coupon payments. There's a fixed coupon, a floating coupon, a zero coupon bond, a deferred or split coupon, and a step-up coupon. And of course, the text will elaborate a little bit more on what these specific different types of bonds and coupon payments and whatnot mean. And it is highly recommended that maybe you have like a Word document or something like that where you define each one of these, because when it comes time to take the final exam, hint, 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 you will need to know these terminologies, okay? For U.S. government bonds, you have bills, which are less than a year. You have notes, which are more than a year and less than 10 years. You have bonds, which are more than 10 years. And then you have TIPS, and TIPS stands for Treasury Inflation Protected Securities. Now, we also have bonds at the state, county, and municipal level. So state of Florida, Broward County, and then Pembroke Pines bonds, right? And then here you have, this is where the states and the counties are trying to seek some revenue, and there's also a general obligation for them to pay on that bond. So when we're discussing bond issue, you have private placement and then public markets. And we also have some different rating agencies. So S&P, Standard and Poor, or the S&P, I'm sure we've heard of it, and Moody's are some of the rating agencies that they look at these bonds and they give it a rating. And these ratings normally matter because it tells us about the performance of the bond and whether or not it's risky. It also incorporates in it the strength of the entity that's issuing the bond also. Okay, so whenever Standard and Poor has a triple A, Moody's has an A and then two lowercase a's, it's an investment grade. The risk is almost zero. When the Standard and Poor is double A, Moody's is a big A, little a, investment low risk, right? Um, so normally like a triple A bond would probably be like a municipal bond or something like that because there's a steady income stream coming from the government and it's almost guaranteed. So there's no risk, not a whole lot of risk that the government is going to go bankrupt, right? When S&P gives you an A, Moody's has an A. That's where they coincide in one of three different areas. This is an investment grade, and the meaning is that it's risky only if if the economy declines. When S&P has a triple B, Moody's has a Baa. It's an investment grade. There's some risk, more if the economy declines. A BB on the S&P and a BA on the Moody's is a speculative grade. So now we're dealing with risky. So now if you kind of want to put a line here, going from here down, this is generally more risk. And then looking at these right here, the upper two are little to low risk, and then here when you're dealing with A and triple B on the S&P, you're dealing with a little bit more risk, right? So now coming down here, a B and a B on a Moody, which is where they coincide also. Speculative grade, it's risky and it's expected to get worse, right? Now we're dealing, looking into probably like mortgage bonds or something like that when it was evident that the market was collapsing. A triple C on a S&P and a CAA on the Moody's is also speculative, probably will undergo bankruptcy. The same holds true for a double C on S&P and a CA on Moody's, probable bankruptcy. And S&P C, Moody C, another area where they coincide. Speculative is when they are in bankruptcy or default, and same for S&P when it's in a D. Speculative and bankruptcy or default. Okay, so if you are a pursuing an investment and you're looking into purchasing bonds, where you want to be at is here, right? You don't want to put in a little bit. You don't want to lose any money, right? Who wants to lose money? So then these are investment grades. These are investment grades as well. And then this is when it becomes speculative on the double B Standard and Poor's or the BA in Moody's. Key takeaways: bond features that can determine risk and return are coupon and coupon structure, maturity, callability, and convertibility, security or debenture, seniority or subordination, and covenants. And U.S. government issues treasury bonds, bills for short-term borrowing, notes for intermediate-term borrowing, bonds for long-term borrowing, and TIPS, which are inflation protected. And then there's also different kinds of treasury bonds. And if you Google U.S. treasury bonds or U.S. government bonds, you'll see that there's all these different types of bonds. You'll see that there's T notes, and then there's EE bonds, and then there a whole bunch of they're like a market on its own. But these are generally guaranteed bonds that there's zero risk of losing your money because it's government. So government is not going to go bankrupt. State and municipal bonds issue revenue bonds secured by project revenues or general obligation bonds secured by the government issuer. State and muni bonds, I skipped over. State and municipal government muni bonds, I should say the whole thing, may or may not have tax advantages for certain investors. Generally, when you're dealing with government bonds, there is a tax incentive because I mean, you're letting the government borrow your money, and there's almost always a tax advantage there. But you want to make sure. Corporate bonds may be issued through the public bond market or through a private placement. U.S. government bonds are issued through auctions managed by the Federal Reserve Board (FRB). The secondary bond market offers little transparency because of the differences among bonds and the lower volume of trades. And to help provide transparency, rating agencies analyze default risk and rate specific bonds. Learning objectives of bond values. Explain how bond returns are measured. Define and describe the relationships between interest rates, bond yields, and bond prices. Define and describe the risks that bond investors are exposed to. Explain the implications of the three types of yield curves. And assess the role of the yield curve in bond investing. Bond value. Like any investment, a bond is worth the value of its expected return, and that value depends on the amount expected and the certainty of that expectation. Bond returns two cash flows to their investors, which one of them is the coupon, which is the interest paid at regular intervals, usually twice yearly or yearly, and repayment of the principal at maturity. So then once they pay you back, once you hold the bond for a certain amount of time, you get back your initial investment. So, an example of this, a hypothetical example is like, let's say you buy a bond for $1,000 and the bond has a 10% coupon payment, right? This is overly optimistic bond talk here. But then over time, you're going to get your coupon payments of 10%. And then at the end of the term, you get back the money that you let them borrow. Okay, I hope that makes sense. If you have questions about that, please email me. So keep the questions coming. Rate of return. You have currency yield, yield to maturity, holding period yield. So current yield is held for 1 year. Yield to maturity is when it's held until maturity, and then holding period yield is held for the holding period or until it's sold. So the current yield is held for 1 year, and you get paid in the form of a coupon payment. Same holds true for the yield to maturity. Held until maturity, you get coupon and market value back. And holding period yield held for a holding period until sold, and then it's either you get coupon payments, and then you could have experience a loss if you sell before maturity. If interest rates increase, bond current yields increase. If interest rates decrease, bond current yields decrease. If interest rates increase, bond yield to maturity increases. If interest rates decrease, yields to maturity decrease. Bond prices decrease if interest rates increase, and bond prices increase if interest rates decrease. You may want to note this for the final exam. It is extremely probable that it will be there, and hopefully you're watching this video because this is a pretty good hint of what you are going to see. Bond value. So then there's certain risks also involved in bond value. You have interest rate, reinvestment, inflation, and default risk. Some of the interest rate risks, you have the market value of it. Reinvestment rate it impacts coupon value. Inflation risk impacts market value and the coupon value. So an example of this specifically is going back to the example of the $1,000 bond. If you're getting paid 10% on it, and then all of a sudden the dollar of the value decreases significantly, the value of the coupon payments of 10% are going to be significantly lower because your purchasing power just dropped. So it's not adjusted for inflation. They don't do you that favor. I mean, that's a separate incident, right? So that's the risk that you take. But I mean, you're generally not gonna, as an individual specifically, you're not gonna buy millions of bonds and then experience that loss. That's more like if you're managing a company's assets and you're trying to hedge against losses, that's something to take into consideration. And then you also have default risk, market value, which impacts market value, and the coupon value also. So an example of this, and it's an interesting case if you want to look at it yourself. I never really had a chance to follow up on this, but I read on the news a while ago that Detroit, the city of Detroit, was going to file for bankruptcy. So then what happens? There's that risk that the city cannot afford to pay its bondholders. So this is the risk that we're talking about, default risk. It's the same thing, like if you have a credit card and hopefully not, don't want to jinx it, but if you have a job and then you no longer have the job or you lose the job for whatever reason, you're unable to pay your creditors or your credit cards, that you have defaulted on that loan, right? So the same holds true for bonds. Bond issuers may also default as well. So you want to be mindful of where you're buying your bonds from. Yield curve. An upward sloping yield curve can have long-term interest rates or economy. Upward sloping is higher, and in upward sloping is expanding in the economy. When you have a flat yield curve, long-term interest rates are the same, and then the economy is flat. Upward sloping, the economy is contracting, and long-term interest rates are lower. Okay, so what did this add here? All right, so then this one is, I think, expanding, flat, contracting. Okay, yeah, this brings in the same information here, but now we have interest rate risk, reinvestment risk, and inflation risk added, right? When the yield curve is upward sloping, the interest rate is higher, and reinvestment risk is lower, and inflation risk is higher. Okay. When it's a flat yield curve, interest rate risk is the same, reinvestment risk is the same, and inflation risk is the same. And then downward sloping, interest rate risk is lower, reinvestment risk is higher, and then the inflation risk is lower. All bonds expose investors to default risk, which is the risk that coupon and principal payments won't be made. Like I mentioned in the example of Detroit, Michigan, for example. Um, Reinvestment risk is the risk that the coupon payments will be reinvested at lower rates. The interest rate risk is the risk that changing interest rates will affect bond values, and inflation risk is the risk that inflation will devalue bond coupons and principal repayment. Bond returns can be measured by yields. The current yield measures short-term return on investment. The yield to maturity measures return on investment until maturity, or until the end of the period when the bond becomes mature. The holding period yield measures return on investment over the term that the bond is held. There's a direct relationship between interest rates and bond yields. There is an inverse relationship between bond yields and bond prices. So this is what this means. Whenever you see that there's a direct relationship, statistically, what that means is that as one goes up, the other goes up. So then what this is saying is that if there's what it means is that if there's a direct relationship with interest rates and bond yields, this means that as interest rates go up, bond yields also go up, right? Whenever you see the word inverse relationship, that's statistical terminology, meaning that as one goes up, the other one goes down, and vice versa. When one goes down, the other one goes up. And I hope that makes sense. There's an inverse relationship between bond prices, market value bond prices, and interest rates. The yield curve illustrates the term structure of interest rates, showing yields of bonds with differing maturities and the same default risk. The purpose of a yield curve is to show expectations of future interest rates. The yield curve may be upward sloping, indicating a higher future interest rate, flat, indicating similar future interest rates, or downward sloping, indicating a lower future interest rate. Learning objectives of bond strategies. Discuss diversification as a strategic use of bonds. Summarize strategies to achieve bond diversification. Define and compare matching strategies, and explain life cycle investing and bond strategy. Another way to look at the effect of default risk on bond prices is to look at spreads. And what is a spread? Great question. A spread is the difference between one rate and another. And with bonds, the spread generally refers to the difference between one yield to maturity and another. Spreads are measured and quoted on basis points. Sometimes if you get a little bit deeper into finance and you want to pursue like a bachelor's or master's degree in finance, you'll see this used often, basis points, but a lot of times it's also called bips for short, not BP. It's called bips. Okay. Or sometimes you might even see BP, but that's whenever you hear bips, that's what this means, basis points. And a basis point is 1/100th of a percent, or 0.00001, or 0.01%. Okay, so it's a 1/100th of a percent. So if you take 1% and then you divide it into 100, one part of that 100 is a bip, or 1 penny. If you think of 1 penny, this is exactly what it is. 1 penny relative to $1. If you think of it that way, it makes a lot more sense. Risk of corporate bonds, you have interest rates, reinvestment, inflation, and default risk for corporate bonds. Now, if you notice, default risk is not present in government bonds. With government bonds, you have interest rate, reinvestment, and inflation risk. Although, in my experience and my opinion, you can also put default risk there. Although, when it comes to government bonds, the assumption is that they're virtually 100% guaranteed, because even if a country, or I'm sorry, not a country, but if a city is unable to satisfy its obligation, its loan obligations, or its obligations to its bondholders, they can file for bankruptcy and find a way to get the money to pay you back. So and corporations don't necessarily have that privilege of being so close to the entity, which can just print the money to help the city satisfy its loan obligations. Bond strategies, here we have spreads, corporate yields, and or treasury yields default risk. When spreads are widened, the corporate yields are higher, treasury yields are lower, and default risk is higher. When the spreads are narrow, corporate yields are lower, treasury yields are higher, and default risk is lower. This illustration will make sense if you look at if you just Google bond spreads and you can look at some of the images. It'll make a little bit of sense. When the spreads are constant, corporate yields are lower, treasury yields are lower, and default risk is unchanged. When spreads are constant, corporate yields are higher, treasury yields are higher, and default risk is unchanged. So you have short-term and long-term bond strategies. With short-term, there's less risk, and then long-term, there's more risk. The reason for that is if the value of the dollar can change, certainly, over a 10-year period, right? Right now, our gasoline, our like the money that we have purchases less gasoline than it did before. So the value of the dollar is going to change. That's for certain. So when you're looking at long term, you're going to experience that type of risk also, in addition to interest rate risk and inflation risk and all this other type of risk. But when you're dealing with short term, there's a whole lot less risk because it's just a 1 year time period at the very least. Matching. So you have immunization, cash flow matching, and bond laddering. Immunization, with immunization, we're looking at balance, interest rate, and investment risk. Now, this is, probably thinking to yourself, immunization. We're not talking about vaccinations or shots. We're talking about this word right here in the middle, immunization, money. Okay, we're talking about that. With cash flow matching, we're talking about timing cash flows, and bond laddering, we're dealing with liquidity. Life cycle investment, allocation to stocks, allocation to bonds, and then you have age. Wish this would explain it a little better. Key takeaways: one strategic use of bonds in a portfolio is to increase diversification. Diversification can be achieved by an active strategy using individual bond selection, or by a passive strategy using indexing, which is when you have a combination of securities. Spreads indicate the price or the yield on the default risk. Matching strategies to minimize interest rate and reinvestment risks can include immunization, cash flow matching, and bond laddering. And I will highly recommend that you get the terminologies of these three and then keep them handy for your final. Memorize them. Life cycle investing considers a relationship of age and risk tolerance to the strategic use of bonds in a portfolio. And this concludes the video lecture for chapter 16 of the personal finance text. If you have any questions, comments, or concerns, please feel free to email me and I'll be more than happy to assist. And as always, since I'm a big advocate of participation and I want to make sure that you're watching these videos and taking advantage of the fact that I'm one of the few faculty members that actually facilitates these PowerPoint presentations for you to watch, if you can send me an email with this image, just let me know what this image is that I'm pointing at right now. I will give you extra credit for participation. Okay, so just shoot me a quick email and I'll add that to your grade. And again, any questions, email me. Have a great night.